Welcome to our webinar, and thank you for taking the time out of your busy day to join us. We're in the Chicago area, and I see that we have attendees from all over the country joining us today. Welcome. We're happy to partner again with one of our most popular speakers and a professional trader with over 30 years of experience to bring you this trading webinar today on the mechanics of a basic option trade. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. The session today will last approximately 1 hour. Our speaker will talk for approximately 40 minutes, and then we'll go to Sean Heron, eOption's president, who will walk you through a live demo on how to enter our option trades in our easy-to-use trading platform. We'll then open it up to Q&A to answer all your questions in about the last 10 minutes. We ask that you look now to locate the Q&A box on your screen. If you have any questions during the webinar presentation, please feel free to type them into the Q&A box, and our speaker will answer those at the end of his presentation. We ask that you use the Q&A box and not the chat box, as our speaker will only see what's in the Q&A box. And to tell you just a small bit about eOption, as our name implies, we're a brokerage firm that specializes in stock and options trading. We offer you some of the lowest rates in the country, including zero commission on stocks and ETF trades, and options are just 10 cents per contract. And you can trade on our powerful trading platform and mobile app. Our founder was one of the founding members of the Chicago Board Options Exchange and has been an active stock and options trader for over 45 years. He created his ideal trading company that caters to serious traders and those who have a passion for investing. At eOption, we support trading education, and we encourage you to subscribe to our YouTube channel to see our library of trading videos, no matter what level of investing you're at. We recently revamped our entire page and have playlists on whatever you're interested in. So you can go to youtube.com/eOption and take a moment to subscribe right now if you'd like. And if you subscribe, you'll be notified as soon as a copy of this recording is available. We also encourage you to visit our website at eoption.com. You'll find all kinds of educational material as well as our past webinars and videos. And I'd like to turn our attention to our speaker now, Teddy Keckstadt. Some of you may recognize his name from past webinars he's done with us, and he's one of our most popular speakers. We'd like to welcome him back today. Teddy is a professional trader and has over 30 years of trading experience. You'll see that he's very passionate about the markets and educating others. He's currently president of Forex Trading Unlocked and the author of the book, High Probable Japanese Candlestick Patterns. So without further ado, I'll turn it over to Teddy and Sean. Thank you.
Hello, everyone. This is Teddy Keckstadt. Thank you, Gina, for that introduction, and welcome everybody to the mechanics of a basic options trade. All right, so let's get going with this webinar. We have a lot to talk about. All right, so about me, we don't need to go over anything, so get ready, all of you bulls and bears out there. All right, so we have a disclaimer for eOption, just to remind you that this webinar is for illustrative and educational purposes only. Everything we're talking about is in a lag and delay. All right, I put my disclaimer up always in the webinar, but we don't need to dwell on it. Okay, so let's get into the meat and potatoes, the parts. All right, we're going to talk about a few stocks today. The stocks are the underlying asset that a person can invest or trade in. We're also going to talk about call options. Now, the difference between a stock and a call option is that a stock is an asset. A call option gives you the right to buy an asset at a fixed price. The fixed price is called the strike price. We'll be talking about that once we get into our examples. Okay, so the length of time before option expiration, we're going to get into that a little bit as well. We're going to talk about how you integrate call option strategies into your trading plan. So not necessarily do you have to follow exactly like the setups that we're going to talk about today and use those strategies, but you can use some of the techniques that we talked about today and integrate them with what you're already using. So what is the proper way to manage the options before they expire? Something we're going to talk about too, about these trades and what you're actually looking for when you actually are buying call options to take advantage of market movement. Also, we're going to take advantage of directional option trade setups. So we're going to talk about all types of ways to use calls to, once again, maximize your capital in the trading environment. All right, so we're going to explore a couple of things. We're going to talk about a little bit of Fibonacci analysis, a little bit of trend analysis. We're going to use some moving averages that are very common for the equity markets. We're going to discuss order entry and also platform execution and how to monitor your trades. So everything I'm going to show you from our case studies obviously is in a lag. However, we are going to have a brief little section where Sean from eOption is going to take over later on, and he's going to enter a few trades on their platform just to show you a live demo before we get to the question and answer. So we have a little bit of two speakers here and a little bit of nice information combined for you. It's a little bit different than what we've done in past webinars. Okay, so how do you make and lose money? So real quickly, this is pretty simple. We're only dealing with one type of trade. These are all bullish scenarios. So when you buy a stock or asset and the market goes up, you profit. Most people are pretty familiar with that. It's not a big deal to understand that one. When you buy a call and the market goes up, you profit as well. And we're going to talk about the difference of why you would want to use a call option versus the stock asset itself. Then we're going to talk about how when you buy a stock asset and the market goes down, you lose money because that kind of happened to you. So we're going to go over our scenarios. We're going to discuss how these things impact whether you either buy the stock or whether you buy a call option. Now, when you buy a call and the market goes down, your risk of loss is defined. So you can lose money. However, unlike a stock where it can theoretically go down to zero, depending on wherever you bought the stock at, or go out of business, what have you, to go down to zero, whatever the conditions, that is theoretically possible, what have you. Whereas with a call option, you can only lose the amount of money that you put into purchasing of the call option. And we're going to go through the steps of that as we get through our case studies. So buying a call is a bullish position. All right. So case studies for option strategies. So we're going to talk about 3 stocks today. One you may be familiar with. You may be familiar with all of them. So the first one we're going to talk about is HP, Helmerich and Payne, and not Hewlett Packard, which most of you are very familiar with, I'm sure. And then we're also going to talk about INT, which is World Fuel Services Corporation, and also DraftKings, DWKG. Now, DraftKings, I'm sure that most of you have seen a commercial or two on TV. So no, by no means is this a plug for any of them. These are for the case studies and for educational purposes. Although they did give us some good examples on what to look at. Okay, so HP, what do we have going on here? There's a lot of stuff. Okay, so if you look at this chart here, you can see that we have these little lines that run through the bar charts here. Now, this one that looks kind of median through the page here, this is a 50-day moving average. So why did I use a 50-day moving average? Well, historically, when people are looking at to buy or sell stocks, they use the 50 and 200 moving day averages as sort of a guide for trend. So meaning that if the equity is below these averages, it is typically very bearish. And if it is above, especially both averages, it is typically fairly bullish. Okay, so now we have a couple of other averages that, as you can see, move closer to the market action. Those are shorter time frame for averages. We have a 13 and a 21. Does this setup of 50-day 13 and 21 mean that is an absolute? Absolutely not. These are just numbers that I typically use when using averages. There's people use all different types of variations for those distances, but you have to remember that the shorter they are and the longer they are will be indicative of how much of a slope and how long it takes for them to actually give you a signal. So looking at this, the market had been trending lower and set a bottom at the beginning of December. Then it made a lower move high, and then it came in the middle of the month, but right before Christmas and the holidays, it made a higher move low. So right off the bat, that would already start to indicate that the market, even though it was in a bear market, was starting to neutralize and potentially be looking for a bounce. Then it actually traveled a little higher. It made this higher move high. Now, this is indicative of a short-term change in trend. Whenever you have consecutive higher move highs and higher move lows, that is an uptrend, and the opposite is for a bearish trend where you would have consecutive lower move highs and lower move lows. These things are very basic in principle, but they're the fundamentals that all traders typically use when they're starting their, not just their analysis, but gauging their trades. You want to know whether you're in a trend trade or if you're in an opposite of a trend trade. So right now, At this time when we were coming up with this webinar, the market had made a higher move high and a higher move low. So on a trend analysis basis, it was giving us a bullish indication. And you see where these moving averages crossed here, the 13 and the 21. This happened right in the middle of this as the market was neutralizing. And then it started to draw up where the 13 starts to lead the 21 day. When that happens, that starts to reinforce the trend. Okay, so even though we're still below the 50, it is something that this market's looking kind of bullish. So when I was looking at the strike prices, the market was trading at $24.98. There's a $25 strike price. So we could basically be synthetically we could either buy the stock at $24.98. So if you wanted to buy 100 shares, you would multiply that times 100. So you're looking at basically just under $2,500 for that trade. Now that is to buy 100 shares, or you could buy the $25 strike price call, which would give you the right to own this stock at that price. So if it goes up, then you would be profiting off of that call. Okay, so now what else is all this stuff here? Now, if you were to buy the stock, let's say instead of the option, you want to know what's your risk level, just like you want to know your risk level when it comes to an option price. Okay, so this last higher move low would be most likely where you would have your risk level if you were not even a skittish bear, but even if you were just to try and buy, if you were looking to buy HP as a trade, not as an investment. When you're investing in stocks, there's a different reason for why and how long you would hold them in your price dynamics. But as a trade, if we're talking about that, which is what we are, you want to know, would you rather buy the stock or buy the option? So if you bought the stock, we know that it would cost $2,500. Okay. Now, if you had a stop in the market and got out, God forbid the market did go south and you were wrong on buying the stock, how much would you lose? Well, you would basically lose just under $3 worth of equity, or excuse me, yeah, because it's $22.17 to $24.98. So yeah, you would be at just under $3 there. Now, how much would that be? Well, that would be around $300. So that's right there, you know that your risk, and that would be as if you had a stop there. Now, as far as the option price, we're going to get into that in just a moment. Now, as far as a target, what would you be looking for? So let's say you were buying the stock and you're weighing the difference between that and an option. If the market's trading right around $25, we have a price area we got to find for targeting. So what I use here is Fibonacci. Now, if you look at, there's a 0.5 number and a 0.618. 50% is a very good target rule function that you can see in equity trading, futures trading, all kinds of trading across the board. Is the 50% rule always something that happens? No, but when it comes to finding a retracement target and even a trend target, it is a minimal for a trend target, and usually it comes into be where the extreme is for a correction. So we already know that this market had been trading lower in a bear market and now has a bullish correction going on. We can't validate it as being truly bullish because it just started to round out a bottom. So if it's in corrective mode or the beginning of a change in trend, having this target of 28.16 to 29.87 is a very rational area. So if you were trading this, you'd be thinking about basically making just over $3 to just under $4 for a market movement should you buy the stock. Okay, so that would mean you would be looking to make around $300 to $400, and you would be risking a total of around $300 to make that. Okay, so now that is a 1-to-1 ratio. And also you have something that you don't have with options. With options, you have a limited risk. You know, we've discussed that, and we're going to show that when we get to the entry price in just a moment. Should you have a big move from Friday to Monday, and this is something that most people never talk about or consider when they're trading stocks versus options, you don't know what could happen. So let's say that there is a big event that happens over the weekend. You know, we have a current thing going on in Europe that could fuel a big slide in the market or a rally. Who knows what the market will do? But let's say that the market closes on Friday, and then all of a sudden something happens over the weekend, and then on Monday the market opens extremely lower. So instead of being able to get out at this 22.17 and only losing from 24.98 to 22.17 with the stock, You could open up at 20. It could be at $15 for all you know, in which case you would get stopped out way below your risk level. So you would lose more money no matter what. Your open risk with the stock is much higher and indeterminate because of these situations. Now, with the call option, you can only lose the amount of money that it costs. So now let's go and look at how this happens. So let's say that you wanted to buy HP. So on the e-option trading platform, you would click on this here, buy to open, first off, because you want to buy and open a trade. Everything we're talking about is buying options. Selling options is for advanced traders, and you're not talking about that at all today, even in the Q&A, unless it's in a combination with spreads. Anyhow, quantity 1. So for this example, we're buying 1 call option with the February expiration. So typically when you're looking for a trend trade such as this, you want to buy an option that is anywhere from at least 30 something to around 45 days out. Could it be 50 days? Absolutely. I would take 50 days over 28 days for sure. You know, so that gives you a little bit more time. Remember that when you buy an option, we pick the strike price. So that gives you the right to buy or own that particular stock or asset at that price. So don't worry about exercising, because we're not even going to get into that. We're going to show you how it doesn't matter. You make your money on the market movement. So we'll get to that as we get through this example. So now the strike price is marked here. It's $25. And here we put it as a call. Remember, this is a call. And then we have a bid and an ask. So the bid is where you, if you already owned the option, you could sell it now at $1.50 or $150, because remember, with options, everything is multiplied by 100. Or you could buy it at $175 or $175, which is what we want to do for this example. And as you can see, the market, I'm not making this up, you can only buy the ask and you sell the bid, because you give up the edge from being off the floor. Also marked down here, it's a simple order. This is just a market order. Okay, right here it says order type. Now you could get into other types of different orders. We're going to keep it really simple. This is just a market order. Okay, so the next slide goes here, and we have a verification. So when you put in that trade, all of a sudden it gives you a verification thing, buy to open 1 contract of HP February 2022 $25 call. Okay, so the price is at the market. Remember, we're keeping this very simple. Now, estimated cost, if we get that price, $175 is the price. Now, with the option, it also breaks down your other commission parts that are part of that. So per trade, there's a commission here. Then you have your ORF fees, your OCOO fee, or excuse me, OCC fee. These are exchange fees. There's nothing you can do about it. Everyone pays those. Estimated net cost, if this gets filled properly, would be $117.16. So it's an extra $2.16 to place this trade. Okay, so as you can see, all those numbers lined up. And now here we go with the order placement. So order placement looks very similar to the slide that we just looked at. And as you can see, we got the price, and now it is a verified trade. Now, the good thing about the verified trade is that now you are live. Once you've done this, you are in action. So if you were to have done this trade, you can see you have my name up in the corner here. So I did this on their paper trading platform and executed this. This is just the same as the regular platform, only it's not real. And it shows you right here. Here's HP February 2022 $25 call. It tells you already the change in price, what has happened since you purchased it, or change percentage also. And it shows you the current bid and ask for the option. It tells you the last trading price. Okay, and then it says your quantity right here, which is +1. Remember, you bought 1. Your cost basis was the 175. Tells you your market value here of 162.50 P&L to open. Now you realize that the market's right where it's at. If you bought and sold an option simultaneously, you'd be just giving up the spread. Even though the market doesn't move, you would be losing that little bit of amount of money. So you need the market to move at least one little price increment to at least break even on the transaction. So this is the HP example. Now let's get to our next one. All right, so now we're going to look at the INT World Services Fuel Company. Now this company, we have the same moving averages set up. Ironically, it's going to be a $25 strike price. We're going to get to that. And if you want to know where this company is at too, I can let you know as far as where it's trading. So it's at around 28.35. So right now, this is about $1 higher than when this example was created. Now this has a similar situation. The stock has been in a bear trend, had made consecutively, it had a lower move high, then a higher move low, then it made a higher move high the day of this example. Okay. And then since then, it has kind of gone sideways to trending slightly higher. So this market is in a neutral to higher outlook. Now, this had a similar situation, but see how this 50-day moving average is? This was coming in right in that day. It pierced it. So this is a good buying opportunity for this stock. This was why we used this as an example for our case study. The market had been making higher move highs and higher move lows. Once again, the trend analysis indicated a bull. We have the market with a 50-day moving average that was coming in where the market was already trying to poke its head above, and we already had a crossover from the 13 and 21-day moving averages giving us a buy signal as well. So all these things made it neutral to higher as far as our outlook. Then we used the Fibonacci, the 0.5 and the 0.618 to give us an upside target area. Now notice we have this downward sloping resistance line that's coming from these two highs. This is keeping the downward trend intact. It comes right into this target zone right here. So this is a good target zone in the sense that if this is just a correction and the markets tend to bounce off of trend lines when they hold a trend, this gives a very good valid price target for an objective to the upside. And also meaning that most likely you're going to see a lot of resistance, not that the market couldn't scream higher, very well. And the stock could double, the stock could be taken over, and all of a sudden there's a bid for $80 a share, and anything can happen like that. But under normal market activity, it's odds are that even if this is a turn in the market, it will run into a little resistance here, probably churn and go sideways and come back a little bit before making another run to the upside, or this will be it before the market starts to fall back and come back to the downside. Now this, we also used the $25 strike price because it was close to the market. It also was where we had our higher move low. So we take the initial low down here as our risk level, and then we use this as our entry price, which is our strike. So now let's compare the strike price risk level and the option versus trading with the equities. So with the equities, once again, this is if you were to purchase 100 shares, it would cost you now over $2,700 to put on the trade. Now your risk is from basically $27.30 to $24.28. That's also $3, just like the last example. So for 100 shares, your risk would be $300 on the trade. Now, as far as upside momentum, you have also about a $250 to $300 something as a potential target to the upside. Now, the good thing about the options is just like you have overnight risk, whatever with stock, market movement affects the options as well. So if the stock was to go up, you have the potential where your option also could exceed these target levels. Hopefully it just gets to where you want it to be, and that's where you would want to exit these trades once they get to these areas. Now the key thing here is also being mindful of the fact that you're risking if the stock comes back down to here, it would be making new lows. For sure, if you were just trading this or investing, you most likely want to have your risk level being based off of this last low here right before the beginning of December, before this uptrend started. Okay, so that's something that's important to know if you were looking at it as a stock. But as an option, the beautiful thing is that your risk is just the price of the option for this strike price. And we're going to compare the difference once we see what the order entry was when we go through that example. Okay, so now we get the same situation as the last stock. And now we're going to see how it actually works when you do the order entry. So with this one, once again, we have a buy to open. Quantity is 1, February 2022, with the strike price of $25. And it's also a call. We have your bid and your ask. Once again, you'll be paying the ask, which is $350. It's a market order, and it's also a simple trade. Okay, so that's how you would enter this trade. And then you would get your next screen, which would be your verification result. Once again, before the trade is actually executed, it makes sure that you've entered everything correctly. So it has your account, it has your buy to open one contract of INT February 2022 $25 call. Price at the market, the cost estimated is $350. Remember that the price to buy the stock was over $2,700. Okay, so when you look at that, the difference, think about how many options you could own if you wanted to spend the same amount of money. So if you really wanted to have, if you were really bullish and you couldn't buy, say, 500 shares of the stock, you couldn't afford that, or you didn't want, because that's not in your risk model, purchasing the options is a much better deal. First of all, you define your risk. The most that you could possibly lose on this trade per contract would be 352.16. Okay, so once the order is placed, again, you have this similar screen, and it tells you where you were filled at, your actual cost, and it confirms total cost. This is your total risk. Should your options expire, worthless, and you don't get out of them. Now, once you put the trade on, you can see that we already have our HP trade in there. Now we have our INT trade. So now, once again, you can see where the current bid and the ask is now for this market. You can see where it traded last, which also is the same for your other options. You can see how they're moving. You can see the quantity, one contract, just like you did of the other, and it has your cost basis. So you can see for these two trades, you would have spent $350 for one, $175 for another. So that's $525 to control two different stocks with the right to buy them at $25. Now, you don't need to exercise the stock. All you need is the stock price to go up. You will realize the same amount of value when the stock goes up as you would with the when the stock goes up, you will realize the same amount of profit on the option. So what do you need to see to make this worth your while? So remember, you were looking for a $3 move for your target move, basically for both of these options. So we'll see how these manifest. We're going to have another case study, and then we're going to see where the pricing ended up with all these trades that we're using for these case studies. Now, remember, the total cost, though, for these two trades would have been over $5,000. That would have been around $5,300 if you were going to put on if you were going to buy 100 shares of stock HP and 100 shares of INT. So that's a lot more than your $525, you know. So also on a risk basis, you know that you're only risking what you paid for those options. If you're wrong on INT and HP and they fall below, especially your risk level on an over the weekend type of event, that's when you stand to lose a lot more. Now, if you're lucky enough that the market opens and stays within relative range of where it's been trading, and you can get stopped out at your stop risk price, that's a good thing. But you don't always get that, once again, especially with the overnight risk between Friday and Monday. So you don't have to worry about that with options. Now, the market may still collapse, but with the option, you're not losing anymore. You can only lose, and once again, you can only lose what you paid for it, which would be the $350 plus the $175 right here. Now, also notice on this thing how it shows you your account value started, your market position value of 460. Okay, and then it also tells you your unrealized P&L. So at this point, putting on these two trades, it would have been minus $65. Okay, now let's get to DraftKings, and then we're going to have it's all come wrapping up to you and see how why you really would prefer, at least I like options when it comes to especially trades. Like investing is a different story. If you're looking for a dividend payout stock in the long term, then it's not about market timing. It's a different type of way of allocating capital. But for trading, especially, options give you so much more bang for your buck, and especially the way they limit your risk, and the overnight risk is the biggest thing between the weekends that most people never discuss or think about, but it does happen, and especially in a market environment like we're experiencing over not just the past 2 years, but even currently right now. Okay, so now DraftKings, this is a stock that most people have seen a commercial for once or twice, I'm sure. We are in the height of football season and what have you. So right now it's kind of funny. When I was looking at the financials, this stock has been trending lower and lower and lower. And for transparency's sake, I actually own this and I own it a lot higher than when this example was. The profits of this company are staggering. It's made almost doubled its revenue in the past year, but for some reason, its profit margins are just slamming through the floor. That's hard to explain. So anyhow, downward trend, you can see keeping this trend intact. So when I was looking at this slide and I'm thinking, okay, well, for sure, I don't want a cannonball. So that means I don't want to add to a stock position. So I'm telling you about, yes, I own this stock and I am down in this stock. So instead of buying more of it, which is what a lot of people will do, and I didn't buy DraftKings as a trade. I bought it as an investment because I honestly thought, they're printing money with the way they're buying. If you know anything about how the sports books run their spreads, they're actually printing money. So, but anyhow, that's right there as a fundamental that gave me a reason to buy it. Now, as a trade, however, or even to not cannonball, I wouldn't buy the stock again. If I want to try and catch a bounce, I would use an option. And I actually bought the $25 calls too. So we'll get to how that's happening and how that's working. So when I was doing this example, we had a reverse head and shoulders forming. It hadn't formed yet, but it was forming. So now notice the 50-day moving average trending's nice on this nice even slope. This is a solid trend lower for the 50-day moving average. Very, very fundamental when it comes to technicals that this market is remaining bearish. And you have both the 21 and the 13 all still right in line. The 13 is below, but it looks like it wants to cross or flatten out. So this could be an indication that we have a short-term bounce. Okay, so another reason to maybe buy this. So then I'm looking at the $25 strike price, which is just below the head. If I was to buy the stock, which like I said, I wasn't going to cannonball and add to a loser, it would cost another $2,700 per block, 100 shares. But if I was to buy it, knowing that this low is here and the way it's trading, I know I would have a stop in at least somewhere around $25. So I'd be risking almost $3 just to try and pick a bottom, which is something you should never do. Never try and pick a top, never try and pick a bottom. Anyone that does, you're going to end up losing most of your money, if not all of it. So that being said, how do you adjust for having a losing investment like this? Well, this is where options come into a really good play. So the $25 strike level, and I was thinking, okay, well, if I have until February, and expiration and Super Bowl is in the middle of February, there's going to be a monstrous kick of revenue. You have all the earnings coming out. Right now, it usually gives a lift to the market. And of course, obviously, we know there's been a lot of volatility in both the NASDAQ, S&P, and the Dow. So has that impacted DraftKings? Well, who knows? This market has been going down when the other broad market was going up. But the situation is ripe for a pop. So we'll see how this manifests. So once again, we have a target area here. We use the 50% and this 0.618 from this, using this high down to this low. We get these Fibonacci numbers. Get the 50% level, which is a typical trading target. Once again, like I told you, with 0.618 being the extreme. Now, this is a nice move. Think about it. Let's just say that the stock gets up there between from the time this webinar was started to the time of Super Bowl. You're looking at it from 27.87 up to 45.14, upwards of $49. It's almost that's upwards of a $20 move for a stock. It's not quite doubling, but that's a huge, huge expected upside target. And look at what your risk level. So now on a stock basis, as long as you don't have that weekend risk, buying this stock and risking down to $25, you'd only be risking basically $3 to make 20. Now that's a really big risk reward ratio. The only problem is never try and pick a bottom. It's a bad thing to do. But with options, you have that opportunity to get in as this market is potentially turning, if it does. All right, so let's get to entering the trade, and then we'll see how all these examples worked out for us. Okay, so with DraftKings, we have, once again, we have a buy to open right there, okay? And we also look at the quantity, 1, always check your quantity, because believe it or not, you can click on one and all of a sudden you're dragging it. You don't realize that the two's there, and it'll be making a big difference in what's going on with your P&L, believe me. So February 2022, once again, make sure that you have the proper month. We have the strike price of $25, and we have a call once again, because remember our other examples are bullish positions, buying calls, and the market at the time of this was 435 bid, 445 ask. For the market would be 445 to purchase. Once again, it was a market order and a simple one. All right, so with that, once again, you get your verification once you try and put the trade on. The cost of this trade at the time of this example was 445 with the miscellaneous commissions at 447.16 should the trade get off. You get your order placement status, your verification, once again, showing you buy to open one contract of DraftKings at February 2022, $25 strike price call. Market order, we got the price we were looking for and total cost of 447.16. Okay, so DraftKings, what's going on here? Whoops. Okay, so DraftKings, as you can see, once we enter the trade, it shows you these other ones here. You scroll down, here's the newest trade added, the DraftKings February 2022 $25 call. Shows you the change, shows you the current bid and ask. Once again, it shows you your quantity, your cost basis as well, the market value. And speaking of market value, it shows up in your position market value. So $985 with an unrealized P&L of $15 at the time of this slide. So that means that the true market value of the position was $970. Okay, so if $970 was the initial cost, you can see now that the position value as of, this was right around 11 something when I did this slide, was at $870. So it was down $96.50 for these total of 3 options. Now, why is that? Well, DraftKings is trading at 21.74 and not above 25. So that is the drag on the portfolio so far, which you can see. Remember, this has your market, where the market is at right now. Remember that we had a position in DraftKings that cost, it was $4 and something cents. This is only $1.31 now, but it still has time. We still have a few weeks till expiration. The HP actually is the one that is up, that's caught a nice little move here, which actually I looked at both these stocks, the INT and HP both had nice little buy signals. So these calls going to expiration or going into the next week or two may still have some potential value. DraftKings also, looking at it the way it's bounced over the last couple of days, may get back close to where the trade was entered. So this is something that can be monitored. Remember, this webinar is for educational purposes, and that's it. I wouldn't say just buy these stocks or try and buy these options. Definitely not in these months, because there's only 6 weeks left. But there is time for a nice little rally. It is earnings season. And if there is a follow through with these stocks, just like there is with the broad market, all 3 of these trades have a potential to still harbor profits. For sure, right now we have HP, which can be liquidated at a slight profit. However, remember we had target areas to the upside, and there's still, like I said, another 2 to 3 weeks going on that. But the key thing you have to think about is, remember the market risk. If we would have bought all of these stocks right now, you would be up on HP, relatively flat on the INT, but on DraftKings right now, you would be down on this one. Okay, and this is where you would have the difference. Whereas with the other 3 stocks, if you were to buy the stocks, now you'd be looking at an over close to $8,000 position at risk. Okay, with this one, we know that it was just over $900 at risk. And between the 3, with 2 winners and 1 loser, you're right now only down $96.50. Now, if you were trading the equities, you would be down thousands of dollars right now. So there's a big difference, between where your risk reward is and what you can do with your capital. Now, obviously, there's different things that you do. You invest and you trade. If you're investing, you have different rationale for why you put your money into equities. If you're trading, though, however, you want to maximize market movements and your potential to capture profit out of the market. And when it comes to equities, using options is one of the best, most secure ways, because especially with purchasing calls or purchasing options in general, you know exactly what your risk is and you can never lose any more than that. So as a little segue, before we get into Q&A, I want to turn the mic over to Sean for 5 minutes, and he's going to do a couple of live demo trades for you, and then we will get to the Q&A and wrap up this webinar.
Okay, great. Thank you, Teddy. Appreciate that, the helpful information. Just wanted to briefly, you should see my screen now here. Okay, so going back over that again, what you see here is my layout. My main screen is a watch list. I'd mentioned the widgets previously. That is in the top right here. And we have many different widgets. You can create your own screens, your own layouts to make it most optimal performance for each of you. So just going to what Teddy was talking about, you know, the charts. So to get that information that he was looking at and analyzing to make decisions, you can come in here. This particular screen is an Amazon chart. I can change that to DraftKings. Teddy was just talking about. And to get some of the information that Teddy was looking at, you can come to this drop down for indicators, and for example, the moving averages, I can create my own moving averages and multiple moving averages. So by doing that, I would just, in this particular sense, create a simple moving average, and the little gear would allow you to change the parameters. I'll make one of them 50. I'll make the color red. And the other one I can change to a 200-day. We'll make that one green. And so what you'll see here are those two moving averages that are displayed on this particular one-year chart for DraftKings. So that's the chart. So I've got, my main screen is the watch list. I've got charts. And then going to what Teddy was talking about, the DraftKings, we can look at those options for DraftKings. And what this is a layout of all of the options that are available on DraftKings, and it's categorized based on the expiration. So we have one this week on Jan 28th. Then you have weeklies going out into March, and then we have monthlies, and then the far out ones would be called leaps. So, you know, if you like DraftKings and you think you might want to buy a little bit of time, I think Teddy was looking at the Febs, or you can even look at the Marches. I know there's some analyst comments today on DraftKings, and that's got some additional movement. It's up 10% today. So if you're interested, so how you would enter an order, the easiest way would just go to the option chain, and you can just click on the bid or the ask. So as Teddy had mentioned, the bid is where the buyers are lined up, and the ask are where the sellers are lined up. And you would just click on, so say you're interested in, maybe it's bottomed out, $20 seems pretty low. You can then enter an order by clicking on the ask, and that'll bring up an order ticket, buy to open. When you're opening a position, you can change the quantity. It'll give you the bid and ask, and then here's the option. I have mine set up as a default to a limit order. Certainly options aren't as liquid as stocks, so I typically look to enter a limit order, and you know, you can go in at, say, maybe it'll come down a little bit, enter a limit at $3.20, and you have to do to buying power. But what it'll do is then allow you to enter that order at whatever limit or market order that you would like to enter. So this is the live trading platform. What you're seeing here is live data, and a couple other things I wanted to go over, useful tools in our platform that you might find of interest for options or giving you ideas about options is some software that we provide free to account holders called Options Play. And this software gives you analytical information on different ideas for how to trade different options. So additionally, it'll show you on the left side ideas based on parameters that you enter, whether you're bullish or bearish, small, medium cap, large cap. If you can isolate it down to different sectors and different scans, and then it will give you certain ideas and give you a score, a probability score, and where it is in terms of where it's trading in the recent past. So look at this particular stock that they have on the top, AMR. It has a 1-month trend of neutral, 6 months of bullish, and so on the middle panel, it's going to show you why, what is happening in the particular stock over the recent past. And then as well, on the right side, it's going to give you 3 different scenarios of how to trade that particular idea. And it's a very useful tool, a lot of information you can change and customize for yourself down here on these P&L simulators. So, before actually buying an option or getting into it, you can, go through these simulators to give yourself an idea, what the potential return could be, what your risk is, what might be the best way to play that, whether it be, buying a call or different ideas. So there's a lot of great information there as well. And, before I wrap it up here and we get to some questions, just wanted to go over a couple other items. One other additional value-added product that we offer is the Daily Outlook. So as Teddy said, we're in the middle of earnings season. And this is a useful tool to give you an idea of what stocks are going to be reporting earnings. Typically there's price action around those events. And so what this is on the left side is our Daily Outlook. This comes out 3 times a day: early look before the market open, mid-morning look gives you an update on where the market is around 11:30 Eastern, a closing recap of where it stands after the close, and then each day you get street recommendations. So these are analyst comments that they make on stocks on a daily basis. They come out before the open, and so you can get an idea of what the analysts are saying. Usually they'll post after earnings. So today you'll see a number of analyst comments on Microsoft. Cowen reiterates outperform. And going to what, Teddy had mentioned earlier, DraftKings. I know I saw Morgan Stanley today came out with a DraftKings comment, upgraded to overweight with an unchanged price target of 31, as recent pullback presents an opportunity. So that stock has gotten some action today as a result of those comments. But going back to earnings, what you'll find on the weekly calendar is this comes out on Friday, and it shows you for the following week, the next week, what earnings are coming, what economic news is coming out each day, what IPOs are coming out, what conferences are going on. So useful information to kind of give yourself an idea of what you might want to watch on your watch list or look at. So for today being Wednesday, you can see earnings after the close tonight. It's a number of stocks coming out, mainly a big one, Tesla, certainly. And so, Las Vegas Sands. So very useful information. I would suggest taking a look at that to give yourself some ideas. So going back here to the watch list, I think that kind of gives you a quick view into how to use the platform using ideas that Teddy had shared. So with that, I will hand it back over to Teddy for questions so that we can get to those.
All right. Thank you, Sean. Okay, so we got some questions, and to make it easier, I'm going to actually go and see if I can pull back a slide or two, because there's a couple of questions on the charts. Okay. There we go. All right, so we have a question here. So first, let's see. From Dale, can you add trend lines to the chart? As you notice here, this high down up where we started this chart here for DraftKings, we use this high and use this following swing high here to develop the basic trend for the downtrend here for the bearish trend. As you can see, it making lower move low, lower move high, and continue consecutive lower move low, lower move high until we had the reverse head or potential reverse head, which obviously didn't turn out to be one. This is when DraftKings was trading at 27.87. Now it's trading 21.68. This is the loser out of the three. So yes, trend lines are very important for just helping to give you a eyeball as to what's going on. Now, what you have to think about too is like, see the slope of this trend line here? It's a very good question. When it's like this is pretty much a 45-degree angle. That's a decent slope. When you have something that's more vertical, either to the upside or to the downside, the steeper it is, that velocity, markets tend to go out like they come in. So you don't maintain just a straight up or a straight down trend. That's usually when you start to see a lot of volatility. But when you see it going like this along a median like this, that's a pretty steady trend. So this is something that's solid. That's why when we were doing this example, never try and pick a bottom, wait for a reason to buy, wait for a buy signal, or in this case where I said for why I would use it and did use it, I already own the stock up in the 50s. So instead of buying more of the stock, this is a great way to capture a potential bounce, which now we just know that I think we said, Sean said Goldman has a price of 31. Obviously that's $10 higher than it is now. Okay, so next question, how do you find liquidity and volatility? That's a good question. It depends on what you mean by liquidity and volatility. If you mean the liquidity and volatility of the individual options, that's a totally different story than liquidity and volatility in other capacities. So if you're looking for the liquidity, you mean that would be market depth. I'm sure that Sean and someone at EOPS can walk you through how to find that out, depending on what you're looking at, whether it's a stock or an option on the trading platform. As far as volatility, there's different ways of gauging volatility as well, depending on whether you're talking about a stock or an option. As far as using the platform and viewing it, for your needs, I would ask the people at EOPS to help you out, like Sean and everyone else there. Let's see, how do you find, can you explain Fibonacci trend target? Okay, can you just more of this? We have a couple of Fibonacci questions. All right, so we use this high for our base for Fibonacci, and then we also use this low down here. So Fibonacci is used for finding support, resistance, retracement targets. In this case, we're looking for a retracement target. So remember, we use 50% and 0.618. So from this high to this low, a 50% bounce would be here at 45.14 in this area here. A 0.618 or almost 62% retracement would be right below $45, or excuse me, $50 at 49.70. So the reason I use 0.5 and 0.618 is that 0.618 is always a really good extreme for any type of corrective move when it comes to Fibonacci. So let's say that this bear market is something that is just going to get a bounce, and DraftKings over the next year is going to continue to trend lower, and it's going to be down by like $5 by the end of the year. Well, before it goes all the way down there's a good chance that it will get a nice little run up, get a lot of fresh buying in, and then come down. Now, if you look at this little area here that's inside this shaded area, see how this is sideways? It pretty much had a base trading here. This right here is a lot of support. That area falls right where our target is. Now, this was support holding the market up, and eventually it failed. Now, a lot of times where the market finds support, If it fails, eventually that becomes resistance. So this area here coincides with this area here. So that would line up with our scenario of why, as far as a correction, this would be a good spot for it to fail completely and then start to resume the bearish trend overall in the longer term. Now, these are moves that take weeks and months to manifest. They don't just happen in days. But it also gives you a reason, if you get above the 0.618 threshold, well, then you're no longer looking at just a retracement. Then you're looking at a solid trend move that is no longer looking, in this case, it would be no longer looking for the bears to come back. You'd be confirming that the bulls found this support again, got above it, and this time would be most likely looking to make a challenge of these highs that we originally had set. So that's one of the reasons why I use Fibonacci. There's all kinds of different lessons on Fibonacci and content out there. I use it in my book as well. I give examples. The reason I like the 0.618 once again is because that's typically the extreme for a corrective price target, and 50% is not just Fibonacci, it's also a Gann number. It's a floor trader's number. It's been a trader's target rule for longer than I've been around, that's for sure. It's been around for a couple hundred years. It's just it's not an arbitrary price target. It's just that markets tend to, once again, if they're only correcting, they usually are not going to go more than 50 to 0.618. That's usually the extreme for a correction. And a lot of time when you have irrational exuberance in the market, if you will, you'll have with the algos that you have in these days, where this market, you can see, doesn't have a lot of range for the most days. But it doesn't mean that you can't have gaps and have trending days where you do have all of a sudden $3, $4, $5 moves. You know, anything can happen in the marketplace. Just remember, never say never when it comes to the markets, because never always happens. Tomorrow is just what doesn't always come. So, let's see, we got any more questions? I think that is pretty much it for the questions. So just want to remind you, thanks again for paying attention to this webinar and me for the past hour. If you don't mind and you have a little time, check out my YouTube channel, Forex Trading Unlocked, and also the book I wrote, High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle versions. Another reason to help reinforce buy and sell signals, which you can trade options off of as well, integrating that into your trading plan. In fact, I discuss it in the book. Also, for more e-option resources for you, don't forget $0 for unlimited stock and ETF trades and 10-cent option contracts. Visit eoption.com for more option strategy resources, and for more videos and on options trading, subscribe to their YouTube channel at www.youtube.com/eoption. And before I turn this over to Sean, I personally want to thank you and remind you about our next webinar coming up on February the 23rd at 1 p.m. Central Standard Time. Ride bullish and bearish swings with options. And with that, I want to turn the mic over to Sean. Thank you, everybody.
Yes, thank you very much, Teddy. It was a great presentation. We appreciate your time and efforts there. Just touching real quick on two questions. Somebody asked about volatility and liquidity. Our option chains have the Greeks and the implied volatility for each option. You can see that there. And liquidity goes hand in hand with volume, and you can also see the volume information on that screen. And another question was about the charts. Do we offer those charts? Yes, our charts are very similar to what Teddy was using, and go to our charts tab and use those and play around with the different indicators and options there. So as Teddy said, you can see our YouTube channel. We have these videos. This will be recorded. You'll be able to see this as well. We have a new promotion starting tomorrow, so watch for that on YouTube. And as always, you know, we're zero commission for stock, and one of the lowest option rates, $1.99 plus 10 cents a contract for options. So check it out at eoption.com. Thank you for your time, and we'll see you next time at the next webinar. Take care.